What if I told you you're living inside your biggest and most powerful financial asset, but you're not actually using it? It sounds crazy, but for most people, their house is just a place to live. For the wealthy, it's a secret bank account they use to fund new profitable investments. So, why isn't everyone doing this? Because tapping into that wealth feels risky. You hear horror stories about people losing their homes, and that thought stops you cold. In this video, I'm going to show you the playbook for safely using your home as a private bank. You'll learn how to start building serious wealth without putting your family or your future in a dangerous position. Here's the biggest problem for most homeowners: your wealth is trapped. You might have hundreds of thousands of dollars in home equity. That's the difference between what your home is worth and what you owe, just sitting there, doing nothing, earning you nothing. It's dead capital. Think of it like a savings account that pays 0% interest, while inflation silently eats away at its value every single day. This isn't just a small missed opportunity. It's the main reason most people's wealth never grows beyond the house they live in. They own a powerful asset, but only use it for shelter. The wealthy see it differently. They see their home equity as a tool. They know this capital can be put to work to generate new income and multiply their net worth. The secret is learning how to deploy it intelligently, just like a bank uses its money to make more money. So, how do you actually turn your house into your own private bank? It comes down to using one of three key financial tools. Think of these as different types of accounts in your new Bank of You. First up is the Home Equity Line of Credit, or HELOC. This is basically your bank's flexible checking account. It's a revolving line of credit you can draw from whenever you need it, and you only pay interest on the money you actually use. It's perfect for projects where you need cash in stages, like renovating a property, or as a seriously powerful emergency fund. Second, we have the home equity loan. This is more like a classic business loan. You get a lump sum of cash right up front with a fixed interest rate and a predictable monthly payment. This is ideal when you know the exact cost of something big, like the down payment on a rental property. Third is the cash out refinance. This one is the big reset button. You replace your current mortgage with a new, larger one and pocket the difference in cash. This strategy can be a great move if you can also lock in a lower interest rate on your entire mortgage. But remember, it usually means resetting the clock on your loan term. There's no single right answer here. The right tool depends entirely on your goal. Let's make this tangible. Imagine you have $100,000 in equity you can tap into. You decide to open a HELOC and use that $100,000 as a down payment on a $500,000 rental property. Let's say your borrowing cost on the HELOC is 8%. Now, after all your expenses, your new rental property generates a 6% net cash return and appreciates at about 3% per year. That's a total return of 9%. In this scenario, you're borrowing at 8% to make 9%. You've created a positive spread. You're using other people's money secured by your house to buy an asset that pays you more than your cost of borrowing. That's the heart of the strategy. But here comes the most important question: is it worth the risk? Because there is risk. What if interest rates on your variable rate HELOC shoot up? What if your rental sits vacant for 3 months and you have no income to cover the debt? This is why you have to stress test your plan. If a rate hike or a few months of vacancy would bankrupt you, the deal is too risky. You have to be ready to walk away. The difference between a savvy investor and a gambler comes down to one thing: risk management. First, never get greedy. Just because a bank says you can borrow 85% of your home's value doesn't mean you should. Always leave a conservative buffer. Second, and this is non negotiable, you must have a cash reserve. Before you even think about doing a deal, you need at least 6 to 12 months of payments for all your obligations, your primary mortgage, the new debt, everything, in a separate liquid account. This is your shield. It protects you from market shocks and unexpected vacancies. Your house can be so much more than just a place to live. It can be the engine that powers your financial goals. But this isn't a get rich quick scheme. It's a strategic tool that requires a clear plan, disciplined execution, and a deep respect for risk. When you use it correctly, it can open doors to opportunities you never thought possible. If you got value from this breakdown, do me a favor and hit that like button and subscribe for more strategies like this. And now I want to hear from you. Drop a comment below and let me know, what's the first investment you would make if you could tap into your home equity safely?